Welcome to this session. In continuation to the previous session where we discussed the problem of moral hazard, how moral hazard problem influence the financial structure in debt market and equity market. In continuation to that, in today's session we are going to discuss what are the tools to reduce the moral hazard problem in both equity and debt market. So, we have seen that borrowers have incentive to take on projects that are riskier than lenders would like to because of the moral hazard issues, right. So, let us go one by one what are the tools to help solve the moral hazard problem in debt contracts to begin with. One of the solution is to increase as for net worth and collateral. That means when borrowers have more at stake because of their net worth is high or the collateral they have pledged to the lender is valuable, the risk of moral hazard, that the temptation to act in a manner that lenders find objectionable is greatly reduced because the borrower themselves have a lot to lose. So, that means these are incentive compatible. That means high net worth and collateral provide to the moral hazard problem is to say that it makes the debt contract incentive compatible. That is, it aligns the incentive of the borrowers with those of the lender. That means the greater the borrower's net worth and collateral pledge, then the greater the borrower's incentive to behave in the way that the lender expects and desires, the smaller the moral hazard problem in the debt contract. Conversely, also you can see that when the borrower's net worth and collateral are lower, obviously you know that there is moral hazard problem is greater because they have, the borrowers have nothing to lose, right. They have very little things to lose, so that they will engage in moral hazard problem. So, here one of the thing as I mentioned here, that increase the collateral, that is one, and second one is also to ask is to increase give loans to debt to only those firms who have high net worth. Net worth means here the equity capital, that is the difference between assets and liabilities. So, overall based on this we can see that higher the net worth and collateral the firms are having, they will be having less probability or less likelihood of making default, right. This is one option, one tool. And the second one is monitoring and enforcement of restrictive covenants. That means that we have seen that actually the debt contracts full of more of restrictive covenants. There are lots of restrictive covenants. So, one is actually the, what is meant by the first one, covenants. What is meant by the covenants here? So, the covenants to discourage undesirable behavior, that is one. So, that means the covenants can be designed to lower moral hazard by keeping the borrower from engaging in the undesirable behavior of undertaking risky investment projects. So, that means in the debt contract itself include all these covenants, that means don't engage in undesirable behavior. So, some covenants mandate that a loan be used only to finance specific activities such as the purchase of a particular equipment or inventories. So, what is the exact purpose for which the loan is taken? So, it can be used only for that specific purpose, then only the loan amount will be dispersed. So, others restrict the borrowing firm from engaging in certain risky business activities such as purchasing other businesses, that also sometime it will be included. And second one is to encourage desirable behavior. That means, for example, it can encourage a borrower to engage in desirable activities that make it more likely that the loan will be paid off. So, you can give one example, for example, is that by buying insurance. Suppose someone has taken a mortgage loan. So, here the thing is that the one such a restrictive covenant requires the owner of the household, for example, who has taken this mortgage loan to buy life insurance, so that he will pay off the mortgage upon the person's death. So, for businesses, restrictive covenants of this type focus on encouraging the borrowing firm to keep its net worth high, because higher borrower net worth reduces moral hazard and makes it less likely that lender will suffer losses. So this is the second one, and as I mentioned here, the home mortgage require homeowners to purchase fire insurance or make monthly deposits towards payment of their property taxes. So these all will be part of the debt contract there. So this kind of covenants will be included. And the third one is to keep the collateral valuable. So collateral valuable here means because collateral is an important protection for the lender. So restrictive covenants can encourage the borrowers to keep the collateral in good condition and make sure that it stays in the possession of the borrower. So this type of covenant ordinary people encounter most often. So for example, in the case of automobile loan, suppose if you have taken an automobile loan, a vehicle loan, you will be asked so often, that means require the car owner to maintain a minimum amount of collision and theft insurance and prevent the sale of car unless the loan is paid off. So that means you cannot sell your once you have taken your automobile, that vehicle loan, you cannot just simply sell this car to other person. You need to complete the pay off the full loan, or otherwise you get the certification or no objection from the banks, right? And similarly, minimum collision and keeping the property in good condition. Similarly, taking a mortgage, a home loan, there also you have to keep it will be part of the loan agreement that you need to keep the property in good condition. Another thing is that provide information, that means quarterly accounting and income reports. That means it also require a borrowing firm to provide information about its activities periodically in the form of quarterly accounting and income reports, so thereby making it easier for the lender to monitor the activities of the borrowing firm. The overall objective of all these things is to reduce the moral hazard problem. So all these factors which we have seen in the beginning of the session, I mentioned the previous session, I mentioned that actually the debt contracts are with lots of covenants, lots of restrictive practices, and the why this include, because in order to reduce the moral hazard, and these are the kinds of restrictive covenants they include in the loan agreement even. And even not only this, even too by dispersing or releasing the installment, a loan installment, you won't be getting, suppose you have got a housing loan, for example 10 lakhs, you won't be getting the entire amount in one go. What they will do, that they will be releasing it step by step. That means each of the agreed activities in the construction of the home is completed, then you will be getting your installment accordingly. So these are actually to ensure that the fund that you borrowed, it will be used mainly for the purpose which is intended to use, right? So that means it also explains the debt contracts that have numerous restrictive covenants. Another solution to reduce the moral hazard problem in the debt contracts is that financial intermediation. So because as we said that here, the fact that we discussed in just previous slide, that means debt contracts involve lots of covenants, because all it require constant monitoring, right? It all require constant monitoring. Suppose similarly look at for example in the case of equity market, you see that it is actually difficult for each and every shareholders to monitor how the managers are doing. It will be difficult, and not only if a few are, suppose they think that they are interested to monitor, because they think that their money is involved, their stake is involved. Suppose when they keep on start monitoring the company is working, then obviously you know that there is free rider problem. So at the end of the day, you can see that because of free rider problem, those who have been doing the monitoring, they have less incentive to do so, because others are simply free riding what the outcome of fruits because of the monitoring. And actually the constant monitoring and enforcement, these are costly for an individual borrower or an individual shareholder. So because of that, in the debt contract you can see that instead of direct finance, suppose if you instead of you pay directly to a borrower, the lender, they prefer to lend their money to the borrower through banking system or financial intermediaries. Because why? For example, financial intermediaries, take the case of for example banks. You know that banks, because they have the expertise in understanding the default risk, and also they have the managerial and technical capacity to monitor the activities of the borrower, and because of that they actually have more expertise. And not only that, they have the incentive to do so, because they are monitoring the activities of the borrower for only of those customers who have taken loans from them. Actually, this is not traded in the market, so these are private loans. So there is no free rider problems on the monitoring and enforcement of banks. If a bank monitor a customer, those who have taken private loan, and the outcome, actually no one is going to exploit, because this is only for a private loan, so there is no free rider problem at all on the monitoring and enforcement of banks. Thus this is one of the reasons that the moral hazard is another reason why the existence of financial intermediaries in the financial markets. So this explains, that means why fact number 3 and fact number 4. So this is the summary table that explains the asymmetric problem and the tools to solve them. So this is a summary table. This I have taken from the main textbook, Mishkin textbook, Economics of Money, Banking and Financial Markets. So here one by one, for example, asymmetric information problem, adverse selection problem, and these are the tools to solve it. I want to again say that we cannot completely eliminate this problem, we cannot completely solve it, we can only minimize this problem, the adverse selection problem. Still, if you look at the finance market, you can see that there are always adverse selection problems are there, that is more prevalent in the finance market. And this also explain the fact number, these many fact number which are all mentioned here. So that all this for a summary. Then coming to moral hazard in equity contracts, separately that equity contracts, these are the tools to resolve it. Then in the debt contracts, these are the tools to minimize the problem of moral hazard. So these are the two kinds of resulting outcome of asymmetric information that we mentioned, adverse selection and moral hazard. And as we discussed in previous session, that if these two problems are not solved or not minimized, the market, the finance market is going to collapse, actually the complete market failure. Because of this market failure, you can see that there won't be a financial market at all. So that means if there are no finance market, actually you know that the growth of any economy actually depends mostly, also depends mostly on, apart from other conditions, depends mostly on how sound is their financial market. Because transferring resources from the lenders who are having surplus fund to the needy people, to those who can make the best use of these funds, who can make use this capital in an efficient way. In order to make this flow of fund, we need a sound financial system. For that, these two problems, the resulting from asymmetric information, that adverse selection and moral hazard, it should be reduced. Then only we can ensure that there is a sound financial system, which would eventually lead to high economic growth, employment and increase in the standard of living of people. So now, after discussing all these things, let us see that how financial development, that means reduce asymmetric information problem and can lead to economic growth and economic development. So the recent research has found that an important reason why many developing countries are still poor, or their economic growth is still lagging behind, experience low rates of economic growth, is that their financial systems are underdeveloped. That means a situation referred to as financial repression. So that means these are all actually created by an institutional environment. This characterized by, for example, one is a poor system of property rights. Poor system of property rights, that means unable to use collateral efficiently. So because we have seen the points that we have discussed here, we have seen that in order to minimize adverse selection and in order to minimize the moral hazard problem, one of the solution is to use collateral and net worth. And you know, actually in countries, developing countries, the collateral, actually the legal collateral, the legal title to the collateral is actually to some extent is non-existent. So in order to get the legal title to their property or land, for example, it is not that strong. So because of that, you know that to get a loan, when someone wants to take, an individual he wants to take, or someone, a startup who needs capital, if he or she wants to take loans from the market, and you know that they don't have much collateral, they don't have sufficient collateral. Even if they have collateral, you know that suppose the lender lender will be unable to use this collateral efficiently. Suppose in the case of default of loan, the lender cannot easily acquire the collateral of the property which is pledged by the borrower. So that means poor system of property rights is prevalent in developing countries. That is one issue. And second one is that the poor legal system. This also, not only that, there is the collateral, the legal title to collateral is weak, sometimes non-existent. You can also see that the legal system is also poor. So the number of cases pending in the court, it will be long, a large number of cases still pending in the courts. So suppose here, because of that, suppose someone, the lender who is not getting back the loan amount, then you know that if he or she approaches the court, it will take lots of time, or it will be difficult for the lenders to enforce the restrictive covenants. So we have seen that banks are actually enforcing lots of restrictive covenants. For example, the borrower need to buy insurance, or borrower need to ensure the property in good condition. What if the borrower is not doing that? So then obviously you know that normally the lender needs to, there will be some tool actually not releasing the installment, that is one. However, you know that if the lender need to approach a court, you know that how lengthy the process is going to, and how difficult for lenders to enforce restrictive covenants. That actually this kind of issues are more prevalent in developing countries. Then comes actually weak accounting standards. So in order to make the information clear, that means revealing the information honestly, that means the normally independent auditors and accountants are appointed, but you know that actually the accounting standards in most developing countries, as per the research and from many reports, it has been shown that the accounting practices are often weak. So because of that, there is less access to information of the borrowers, of the borrowing firms, and also about the firms who is issuing IPOs, equity. So obviously you know that all this will lead to information asymmetry, and because of that you can also see that this all actually hampers the working of financial market, efficient working of financial market. Then another thing you can observe that in most developing countries, the government intervention through directed credit programs and state owned banks. So for example, the state owned bank, you can see that what if most of the banks in a country are owned by the government, then you know that when obviously the public sector, many researchers has been showing that public sector actually works less efficiently. Inefficiency is one of the characteristics of public sector enterprises, and here suppose the state owned bank, so you know that they have less incentive to proper channel funds to its most productive use, because most of the time they have to follow the order or the directives from government. Maybe government will be saying that because government has its own priorities, maybe agriculture development or some specific sectoral development, then it will be asking the state owned banks to make directed credit programs, maybe for agriculture loan, and or sometimes for the small scale industries, or encouraging for giving loan for micro finance units. So this kind of practices or this kind of directives, when the banks are getting, they have to actually do all these things, right? They have to follow the order of directives from the government. So because of that, what happened that, because in the beginning of the course I said that the financial system ensure efficient use of capital. where the marginal efficiency of the capital will be high, because in the if you really allow more and more competition and there is the market, financial market is very strong with limited market failure is very low. In that case, we have seen that the funds who will be demanding who is borrowing or raising capital from the market, because they find it the most productive use of those capital as compared to those who are having the surplus capital. Because surplus capital, most household they are having surplus capital, but they don't know how to make the best use of it. So normally this will be lent to this will be borrowed by those who can make the best use of this capital. So, but here you can see that because the banks are government owned, so that they won't be able to make less incentive to proper channel funds to its most productive use. And banks forced to buy, often government banks will be forced to buy government bonds and also to lend government at short notice. That most of the developing countries, low and middle income countries, they are having budget fiscal deficit. That that fiscal deficit is nothing but the borrowing requirements for the government. Right. So that by the end of the financial year, the government need to fill the financial deficit, and where from they borrow the money, mostly they borrow from bond market. And who are the main demanders of these bonds? Mostly these are by the banks, mainly state owned banks, because they are obliged to buy. Right. So these kind of things, what happened that this kind of things lead to a kind of financial repression in these countries, and that means actually their financial system is going to be weak. So looking at these financial systems in developing and transition countries face several difficulties that keep them from operating efficiently. In many developing countries, the system of property rights, whichever we discuss, is function very poorly. So let us see this issue, that the financial repression or a weak financial system, how does it affect the economic growth. So let us take the case of China for example here. That although China appears to be on its way to becoming an economic powerhouse, its financial development remains in the early stages. You might have observed that it has a weak legal system comparatively, and it has poor enforcement of financial contracts as per some of the available research documents and reports. And also it has been recorded that the accounting practices in the country as compared to the other western system, they have low accounting standards, just like almost comparable to India as well, and hard to find high quality information. So regulation of the banking sector in its formative stages in the country. So but you can obviously see that China is one of the fast growing economy in the world and is almost catching up with the US economic growth. So you can see that why high growth rates in the past 20 years in China. Is it because of the financial system, or is it because of something else? So what the research show that is not because of the financial system, is because of some other factors, for example high saving rates. So before that I said that though the per capita income is growing fast, however per capita income is only 1/10 of the USA. However, what contributed to the high economic growth or to make China an economic powerhouse is one actually the high saving rates in the country, in China. So you can see that there was high savings rate. Because of that, increase in capital formation combined with a labor movement from low productivity subsistence sector to the high growth sectors, that is manufacturing and service sectors. That actually the surplus labor moved from the subsistence agriculture sector, and the agrarian economy gradually transformed into industry and service sector economy. So actually research also showed that the China's economic growth would have been even faster if their financial system is also very strong. So when we compare this one, the growth story of China with of the USSR, because USSR was a economic superpower, economic and defense superpower in the 1950s and 60s. So what you can see that actually when we compare these two countries example, USSR shared many characteristics of the modern day China. And you can see that USSR case, they use the scope of labor mobility from subsistence sector to the manufacturing sector. But you know that USSR, they were unable to develop a good financial system. So they have been excelling in engineering and other researches, however, not much in finance research. So maybe that may be one of the reason, because we cannot say there are so many other factors, social, political and other economic aspects, but one of the reason why they couldn't become a economic superpower, one of the reason is that maybe because they didn't have a strong financial system. So you can see here that what happened in China, because they understood, I think, so not all the, as per the many reports is say that China actually learned the lessons from what happened in USSR, for example, because it's almost comparable with the USSR, but China, you know, they understood that next stage of development. The reason when you go through their reports and research papers from China in the recent period, you can see that there have been lots of discussion about developing a robust and vibrant financial system. Right, that means the leadership is well aware of that challenge and they have been working towards that. And so because of that, there are recently, you know, till 1980s, China was almost a communist, that means a public sector economy, but they actually moved to capitalist, that communist capitalist communism, a kind of a system where they encourage industrialization, entrepreneurship and privatization, and lots of banking reforms and legal reforms, etc. So that means we can say that maybe in the present day, these days and the future, maybe their investment, that the acceptance or the appreciation of the importance of strong financial system is happening in China. So in India, also you can see that maybe in Indian case also we can see that why one of the reason why India is lagging behind when it comes to economic growth, though we say that we are the fifth largest economic power, if you looking at the size of the GDP, India stands at the fifth when it comes to economic power. You can see however still you know that the per capita income of country is very poor, low, and many people are below poverty line. So one of the reason maybe the poor financial system. And you know that when it comes to India, when you look at, for example, we discuss bond market and equity market, you know that the bond market in India is relatively less developed. For example, the households, where do they put their money? They put their money in the bank, and bank in fact put it in the bond market. Actually this is the household money, and most households in India, especially in the urban area, they are less aware of the bond market in India, and because of that itself, you know that Indian bond market is relatively, for many, it is less liquid because they are not well aware of how to invest in a bond market, or how, for example, how to buy a bond treasury bill from government, because not many people are well aware, or even they think that is very difficult and practically difficult to do so. And also you can see that the government owned banks, most of that actually in Indian banks, most of the banks, large share of banks in India, you can say that most of them are government owned banks. So you know that government owned banks, we already discussed that they will be forced to invest in government bonds, and they were sometimes often forced to lend to the government. And also you know that Indian bank, one of the thing is that the statutory liquidity ratio is high in India, for example 18.5% recently. So at present, that means of their total deposits, they are required to invest 18.5% mainly in liquid assets, including bonds, government bonds. Also you can see that there are increasing NPS, non-performing assets. You can also see that bank frauds are often happening, and there are lots of awareness issues. We also have relatively poor financial system, etc. So these are all the factors that affect, obviously maybe affecting India's economic growth. So overall in this session we have discussed the moral hazard issues, how to resolve it, and then we little bit applied by taking insights from previous session, how the development of financial system is important for economic growth as well. Thank you.